Preparing for a FP&A Analyst at Coca-Cola interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A do, and how would you add value as an analyst at Coca-Cola? FP&A connects financial information with business decisions. At Coca-Cola, I would support the annual operating plan, rolling forecasts, monthly performance reviews, and analysis of volume, price, mix, revenue, and costs. I would add value by making reporting accurate, identifying the drivers behind variances, and communicating implications clearly to commercial and operational partners. My goal would not be merely to explain what happened, but to help leaders decide where to invest, reduce risk, or adjust execution. While answering, focus on planning, forecasting, performance analysis, decision support, communication, and translating financial results into actions across brands, markets, channels, and operating teams. Question 2. How would you build a revenue forecast for Coca-Cola? I would begin with a driver-based baseline using historical volume, realized pricing, product mix, customer trends, and seasonality. Then I would layer in known initiatives such as price changes, promotions, innovation launches, distribution gains, and expected foreign exchange effects. I would validate assumptions with commercial teams and reconcile the forecast to reported revenue definitions. Finally, I would create upside and downside scenarios, document the key drivers, and monitor forecast accuracy monthly so assumptions improve over time. Make sure to cover baseline trends, unit case volume, pricing, mix, customer and channel assumptions, promotional activity, seasonality, foreign exchange, and reconciliation to historical actuals. Question 3. What is the difference between a budget, forecast, and actual result? A budget is the approved financial plan for a defined period, usually based on assumptions set before the year begins. A forecast is an updated estimate of where results are now expected to land, incorporating actual performance and revised business assumptions. Actuals are the results recorded in the accounting system. At Coca-Cola, comparing actuals with budget and forecast would help separate execution issues from changed market conditions, improve future estimates, and support timely corrective action. In your answer, distinguish the approved financial plan, the updated expectation, and realized performance, while explaining how FP&A uses comparisons to improve accountability and forward-looking decisions. Question 4. How would you analyze a revenue variance versus plan? I would decompose the variance into volume, price, mix, foreign exchange, timing, and scope effects. For volume, I would examine unit case performance by market, channel, brand, and customer. For price and mix, I would assess list price changes, promotions, pack sizes, and premiumization. I would reconcile the bridge to the general ledger and operational data before discussing causes. Then I would explain whether the variance is temporary or structural and recommend actions, such as revising investment or adjusting the forecast. Be sure to mention volume, price, mix, foreign exchange, geography, channel, customer, timing, and data validation, followed by an explanation of business implications and recommended actions. Question 5. Explain price, volume, and mix analysis using a Coca-Cola example. Suppose unit case volume is flat but revenue increases 8%. I would investigate whether higher realized prices contributed 5 points, favorable mix contributed 4 points, and promotions or customer shifts offset 1 point. Volume measures quantity, price reflects revenue per unit, and mix captures the effect of selling different brands, packages, or channels. At Coca-Cola, more premium products or larger multi-packs could improve revenue quality, while an unfavorable shift toward lower-priced offerings might dilute both revenue and margins. Focus on separating growth caused by quantities sold, selling prices, and product composition, and explain why mix can materially change revenue or margin even when total volume is stable. Question 6. What KPIs would you monitor for Coca-Cola's operating performance? I would monitor revenue growth, unit case volume, realized price, product and package mix, gross margin, operating income, marketing investment, and free cash flow. I would also track performance by geography, channel, brand category, and customer where available. For planning effectiveness, forecast accuracy, and the quality of variance explanations matter as well. The important point is to connect each KPI. Volume and price drive revenue, mix influences margin, and investment should support sustainable growth rather than only short-term results. In your answer, include revenue, unit case volume, price and mix, gross margin, operating income, marketing investment, free cash flow, forecast accuracy, and performance by geography or channel. Question 7. How would you explain a gross margin decline despite revenue growth? I would first separate the margin change into gross profit dollars and margin rate. Then I would analyze whether input cost inflation, packaging, freight, unfavorable product or package mix, promotions, foreign exchange, or manufacturing inefficiencies caused the decline. Revenue growth may be driven by low margin volume, while costs rise faster than realized pricing. I would compare actuals with plan, quantify each driver, and assess whether pricing, procurement, mix management, or productivity actions can restore margin. Make sure to cover input costs, pricing realization, product mix, packaging, freight, promotions, manufacturing utilization, foreign exchange, and whether the decline is temporary or requires structural action. Question 8. How would you forecast marketing and advertising expenses? I would combine the approved brand strategy with a detailed spending calendar. The forecast would include committed media, agency fees, sports or entertainment partnerships, promotional support, innovation launches, and expected timing. I would compare planned spending with historical run rates and validate open purchase orders and accruals with marketing partners. I would also evaluate whether spend is supporting volume, revenue, or brand priorities. Any timing shifts should be reflected clearly so leadership distinguishes phasing from genuine overspend. Discuss committed spending, campaign calendars, brand priorities, historical run rates, launch plans, timing, accruals, and measuring spending against expected volume, revenue, and strategic returns. Question 9. What is a rolling forecast and how would you manage one? A rolling forecast continuously updates the expected financial outcome and extends the planning horizon as periods close. I would start with the latest actuals, refresh operational drivers, challenge material assumptions, and meet with commercial, supply chain, and marketing partners. I would document changes from the prior forecast and distinguish business-driven revisions from simple timing movements. At Coca-Cola, this approach would keep leadership focused on the latest volume, pricing, mix, cost, and currency outlook rather than an outdated annual budget. Focus on regularly extending the planning horizon, updating assumptions from actual results, involving stakeholders, documenting changes, and balancing speed with forecast discipline and consistency. Question 10. How would foreign exchange affect Coca-Cola's forecast and reported results? Foreign exchange can affect transaction costs, translated revenue, translated profit, and the comparability of reported growth. I would forecast local currency performance first, then apply approved exchange rate assumptions to estimate reported results. I would also prepare a constant currency view so management can distinguish underlying business performance from translation noise. For example, strong local volume growth could appear weaker in dollars after currency depreciation. I would clearly separate economic exposure, accounting translation, and any hedging effects in the variance explanation. Be sure to cover transaction and translation effects, local currency performance, exchange rate assumptions, constant currency analysis, exposure management, and communication of economic versus accounting impacts. Question 11. How would you partner with sales and marketing when their forecast seems overly optimistic? I would avoid simply rejecting the forecast. First, I would understand the assumptions behind the optimism, such as distribution gains, promotions, pricing, or innovation. Then I would compare them with historical conversion rates, customer commitments, market trends, and current run rate performance. I would build a base case and upside case, quantify the difference, and discuss the evidence with the team. If uncertainty remained material, I would present both scenarios to leadership with explicit triggers for revising the outlook. In your answer, emphasize fact-based challenge, shared drivers, historical accuracy, scenario analysis, respectful communication, documented assumptions, and escalation only when alignment cannot be achieved. Question 12. Describe how you would prepare a monthly management reporting package. I would begin by validating the close data, mappings, and period-over-period movements. The package would include an executive summary, actual versus budget and forecast, revenue and margin bridges, KPI trends, cash or working capital highlights, and key risks and opportunities. I would tailor detail to the audience, keeping the main message concise and supporting it with drill-down schedules. Each material variance should have a quantified driver, an owner, and an action or expected resolution date. Cover data integrity, executive summaries, actual versus plan analysis, key bridges, KPI trends, risks, opportunities, action owners, and tailoring the presentation to senior decision makers. Question 13. What financial modeling techniques would you use in this role? I would use driver-based modeling rather than relying only on percentage growth. Revenue could be modeled through volume, realized price, mix, and currency, while costs could use input rates, production volumes, headcount, and planned activity. I would include base, upside, and downside cases, sensitivity tables for major assumptions, and clear checks against actuals. I would keep formulas transparent, separate inputs from calculations, and design the model so stakeholders can understand and challenge the logic. Mention driver-based models, scenario and sensitivity analysis, historical trend review, linked statements or schedules where appropriate, error checks, transparency, and avoiding unnecessary model complexity. Question 14. How do you ensure accuracy when working with large Excel datasets? I start by confirming the source, period, currency, units, and business definitions before analyzing the data. I use structured tables, consistent formulas, controlled input tabs, and reconciliation checks to totals from the source system. I test formulas with known examples, review unusual movements, and use pivots or queries to validate aggregations independently. Before distribution, I perform a reasonableness review and, for important outputs, ask another person to challenge the file. Accuracy includes both correct calculations and clear documentation. Focus on source reconciliation, controlled inputs, consistent definitions, formula checks, pivot or query validation, reasonableness tests, version control, and review by an independent colleague. Question 15. What would you do if actual results changed after you sent a forecast? I would first confirm whether the change came from a late journal entry, a data refresh, a mapping issue, or an operational update. I would quantify the impact and determine whether it changes a key conclusion. If material, I would notify stakeholders promptly, issue a corrected version, and clearly explain the adjustment rather than hiding it. I would preserve the original file, update the assumptions log, and add a control or review step to reduce the chance of recurrence. Be sure to mention confirming the change, assessing materiality, notifying stakeholders promptly, correcting the forecast transparently, preserving an audit trail, and improving the process to prevent recurrence. Question 16. How would you analyze working capital in a beverage business? I would analyze accounts receivable, inventory, and accounts payable in both dollars and days. For receivables, I would review customer terms, aging, collections, and disputes. For inventory, I would examine finished goods, materials, demand forecasts, production cycles, and obsolescence. Payables analysis would include supplier terms and payment timing. Because beverage demand can be seasonal and promotion-driven, I would distinguish normal buildups from excess stock, then quantify the cash impact and recommend actions without compromising product availability. Discuss receivables, inventory, payables, days metrics, seasonality, promotions, production planning, customer terms, cash impact, and balancing liquidity with service levels and product availability. Question 17. How would you evaluate whether a new product launch is financially attractive? I would build an incremental model covering expected volume, net price, mix, cannibalization of existing products, trade spending, marketing, manufacturing, logistics, and overhead. I would calculate incremental revenue, gross profit, operating contribution, cash investment, and payback period. I would test adoption, pricing, cost, and distribution assumptions through sensitivity analysis. A launch can grow revenue yet destroy value if it shifts customers from higher margin products or requires disproportionate investment, so I would present both strategic and financial outcomes. Include incremental volume, price, mix, cannibalization, trade and marketing investment, manufacturing or distribution costs, margins, timing, payback, and downside risks. Question 18. Tell me about a time you found an important variance or error. In a prior project, I noticed a cost center was materially below forecast despite activity levels remaining stable. I traced the movement to a missing accrual caused by a purchase order timing issue, quantified the impact, and confirmed it with procurement and accounting. I informed my manager before the reporting deadline, updated the forecast, and documented the correction. We then added a recurring open commitments review. The experience reinforced that unusual variances should be investigated before being accepted as favorable performance. Use a concise STAR structure explaining the analytical approach, root cause, quantified impact, communication, corrective action, and the control or lesson that followed. Question 19. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, materiality, and required level of precision. I would prioritize matters affecting a close, forecast submission, major investment, or executive decision while identifying dependencies and reusable analysis. I would communicate trade-offs early rather than silently missing deadlines. When time is limited, I would provide a reliable initial view with stated assumptions, then deepen the analysis if needed. That approach protects accuracy while keeping the business moving. Focus on decision urgency, financial materiality, leadership deadlines, dependencies, data availability, transparent communication, and delivering an accurate minimum viable analysis before adding detail. Question 20. Why do you want to work in FP&A at Coca-Cola? I want to work in FP&A at Coca-Cola because the business combines globally recognized brands with complex decisions around volume, pricing, mix, marketing, channels, and international markets. That creates an environment where analysis directly influences commercial performance. I enjoy turning detailed data into a clear recommendation and partnering with non-finance teams to execute it. I would bring strong attention to detail, structured modeling, and curiosity about business drivers while developing through the company's scale and disciplined planning processes. Connect your motivation to global consumer brands, recurring planning cycles, commercial scale, data-driven decisions, cross-functional partnership, development opportunities, and your specific analytical strengths. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.